If things continue to play out as they are playing out right now, the outlook I've been giving you for years now may turn out to be one of the single greatest economic forecasts of all time. What did I tell you? I told you that the curtain would be pulled back. I told you that reality would return to the markets. What markets? Not just the stock market. I'm talking about the real estate market, the bond market, and we're seeing all sorts of cracks in those eggs now. And it was all about when the focus, which kept the attention of the entire world for the last 2 years and 2 months, shifted, when that wasn't such a thing or a concern. There wasn't as much fear involved with it. That's when this delusional market would start to all come down together. It's all going to come down together. And what I mean by come down, I don't mean a big crash. That's not what I'm talking about. That might be one of the outcomes, but I'm talking about just a gradual return to reality, a softening in a lot of these overextended markets. We're going to talk about all of this stuff, especially the comments from the Dallas Fed about the overexuberance in real estate prices. For many of you, this is your very first time here. My name is Peter Leeds, and I am the small stock specialist. You might ask yourself, why small stocks? Because they produce the biggest gains, if you know how to find them. And please understand that nothing in this video or anything we put out ever is intended as personalized trading advice for you. And we'll start with the good news this time. There is some really strong news from the March unemployment report. We saw 431,000 jobs added. And not just that, but there's also positive revisions to January and February as well. What happens is that a lot of the information comes in a little bit late, and so they get the new information and they adjust what they told you before. But in any case, January was better, February was better, and March was really strong. More Americans joined the labor market, which means that the participation rate has increased and wages have shown a little bit of improvement. Not more than the inflation rate, but they're still improving nonetheless. Other good news I told you about when there's the first unionization at Starbucks. I told you there'll be more at Starbucks, and then it will spread out from there. First it was one Starbucks, then it was many other Starbucks, and now Amazon is starting to unionize. So that's going to be a big trend. It's not necessarily good for the employers. It's not necessarily bad. And just before we get into some things I want to talk about, such as declining auto sales, which could be a prelude to telling you something else, I want to mention that this entire video, the inspiration of it, came from exactly this email which I received. From Dexter. I've been with you for years. I'm very grateful. I came across your channel years ago. I'm just watching everything around me and seeing how years ago you talked about how everything is going to play out and how so true you are about how everything is turning out. Thank you, Dexter. I really appreciate the testimonial, especially when the testimonials are about people who have been around for a while. It's not just some Johnny come lately. He's been following my information for a while and he's understanding it and benefiting from it. But I'll tell you what, Dexter and everybody else watching this video, there's still more to come. The premise I've been giving you is not fully played out. It's just getting warmed up. Now make sure to see the part I talked about with the Dallas Fed, their conclusion about the real estate market. Their conclusion is that there's signs of a market tipping point, so we have to get into that. So first I'll give you a couple other quick things. One is about the auto sales. Ford Motors U.S. sales of new vehicles declined 17% during the first quarter, including a 26% slide last month, as the automaker continues to battle a global shortage of semiconductor chips. Detroit-based GM said that quarterly sales fell 20%. And this is what you should expect to see if you're entering what could be a new recession or the next Great Depression. But since it's based on, and most of it, almost all of it is based on the chip shortage, you don't have to worry as much. But if you see something like this happening even in a slower time frame, like instead of months, it takes quarters, that's a sign that the market and the economy is really going downhill fast. Just like in 1929, before the big stock market crash, there is declines in steel production. You watch steel production, steel usage, and you look at things like auto sales, the main parts of the economy, you can watch as they get weaker and weaker. And that's not the case right now with the auto sales. It's based on the chip shortages. But if these auto sales started to fall without that kind of influence, such as the chip shortages, then that means that we are in a lot of trouble. So watch for that kind of stuff. Or declining real estate prices, which we're also going to be seeing now. And speaking of the semiconductor shortages, that's part of the scrambled supply chains. And what did I tell you? I told you that inflation would come down, especially if my premise plays out. There won't be a lot of people with a lot of money to spend. But I said inflation would come down, and since then what has happened? When new information comes in, you have to bring it into your analysis and factor it into what you're looking at. So since I said inflation would come down, we've got a land war in Europe. We've got another major port shut down in China based on the thing we've been dealing with for the last 2 years and 2 months. Both of those are trends against my premise that inflation will come down. I still believe it will come down. I'm not as confident now with this land war and with all these supply chains getting twisted. But the good news is that we'll be able to watch it the whole way and know as it goes and see if it's going where I'm telling you it's going to go. And just to clarify one thing I have on my notes here, I wanted to clarify that there's 2 types of inflation. There's inflation, meaning the increase in the monetary supply. There's also consumer price inflation. When you go buy a block of cheese, you're like, hey, Sandra, look at how expensive this cheese is. And she's like, oh my goodness, what are we going to do? That kind of inflation, the kind that you see, the kind that you feel. That's generally what I'm talking about, and I generally will indicate if I'm talking about a different type of inflation. FYI. But what did I tell you about the upcoming recession? Before the yield curve inverted, I said, you know when a recession is coming? And I said, there's a way. You look at the inversion of the yield curve. That's usually the precursor to a recession, usually within about 18 months or less, usually less. And now, after releasing that video, now the yield curve is inverted. And there's inversions all up and down the yield curve, which means that the clock is already running on this inbound recession. But I wanted to mention one thing. This is the first time in a long time, if ever, that we've had so much access to information, and therefore so many people with an understanding about how things work. A lot more people today realize that an inversion in the yield curve means that a recession is coming. If everyone is acting on the fact that there's going to be a recession because they saw the yield curve invert and they all understand what it means now, they're going to change their spending habits. So in other words, it can become like a self-fulfilling prophecy in a way unlike it has ever been before. When the bond yield curve inverts, as it did Friday, it's traditionally a harbinger of recession. The 10-year and the 2-year yield curve momentarily inverted this week. Now remember, the big part coming up that you have to see is the real estate warning signs. But let me tell you about how the bond bubble is starting to burst. This is a 40-year bull market in bonds. It's over now. From Axios, no sooner had the first quarter ended with a 5.6% loss for U.S. government bonds than the March unemployment data, including a bigger than expected drop in the unemployment rate, which fell to 3.6%, came out, and that was among the lowest ever recorded, and set April off to a punishing start. When they say punishing start, they're talking about how it affected bonds, the 5.6% decline. Bonds are a flight to safety. When people are concerned, they're more likely to buy government bonds. When people are less concerned, they're more likely to buy Tesla or GameStop. So some money has been flowing out of bonds pretty significantly in terms of what's happened for the last 4 decades up until now. You haven't seen this kind of trend in the bond market during that entire time. The yield on the policy-sensitive 2-year note climbed more than 13 basis points to 2.47%, topping the 30-year rate for the first time since 2007. What else happened in 2007? That was right before the global financial crisis, the mortgage meltdown, a very hard time, mainly for the middle class. The 30-year rate pulled further away from the 10-year yield, which it exceeded earlier in the week. Wherever you look in the bond market, there's yield curve inversions. And this is another slice telling you something. What is this telling you about the economy? The Fed hasn't raised rates by more than 1/4 percentage point since 2000. I'm going to read that again. The Fed hasn't raised rates more than 1/4 percentage point since 2000. Let that sink in. Policymakers have all but announced a 0.5 point increase in May, and the futures markets are pricing in another one in June and beginning to favor a third in July. That's a 0.5 point at each Fed meeting. So you're looking at interest rates being at least, based on that, 1.5% higher. What is that going to do to anyone who has taken on debt? It's going to be a lot more painful to pay for the debt. The servicing costs are going to be ballooning. Now listen to this part. The implied forecast is for the policy rate to peak at around 3% in 2023 and decline in 2024 as higher rates take their economic toll. Now think about that. They're explaining to you what the point of raising the interest rates is. They're trying to do damage to the economy. The economy is running a little bit hot. The inflation is getting out of control a bit. So you know what? Don't worry, guys. We have tools in our toolbox. One of the tools is, and the main tool is, we'll punish the economy. We'll damage the economy. And that way, it'll get back in line with what we want. The point of raising the interest rates is to smash down the economy so that it slows down and it takes care of a lot of problems for them, not for you. But all of this is a big story that I'm telling you, and it's blending down into the most important part of this video. This is from Axios as well. There's more support for a 0.5% interest rate increase now than ever, and expect to see a few of those. All of those will make it harder for people to afford the most expensive thing that generally they buy, which is almost always their mortgage. Mortgage rates are swiftly rising, reaching an average of 4.67% for a fixed 30-year loan for the week ended in March 31st, which is the highest since 2018, according to Freddie Mac. The national median listing price for a home has jumped to a record $405,000, according to Realtor.com. The typical listing price for a home has jumped almost 27% in the past 2 years. And one of the main drivers pushing home prices higher is the lack of supply. But the thing is this, when the economy turns, what happens is that people say, you know what, I'm going to get out of my house now. I can't afford this mortgage anymore, or I think prices might start coming down, so maybe I should cash out now. What happens is that when the economy weakens, as is my premise, there's going to be a lot more availability all of a sudden when people decide, okay, I don't see this market going much higher. That's when they start to unwind their purchase of their home, and that naturally brings more supply onto the market. The supply is going to come back. It's not going to come back because they build new houses. It's going to come back because more people decide to sell. But here's the point that the Dallas Fed economists have decided that there are signs of a market tipping point. And there are 3 reasons why they came to that conclusion. But I like to give you guys another perspective because I always tell you this, and then now they're saying it too. Maybe you'll believe someone else if you don't want to believe what I'm telling you. But they're catching up to what you already knew. So what they're saying is there's 3 factors why the markets are over-exuberant right now. 1, they have an exuberance measure, and when it reaches a 95% threshold, that signals that the market is experiencing abnormal explosive behavior. That's a quote, abnormal explosive behavior. When I read that, I said, take it easy. So 95%, that's a warning sign if the exuberance rating gets to that point. It's at 115% right now. Number 2, another measure of valuation is that they compare home prices against the sum of discounted future rents. And the level of exuberance that metric shows is equivalent to the run-up right before the last housing boom, which ended around 2008, as we mentioned earlier. And 3, the ratio of home prices to disposable income, which is a measure of housing affordability. And while that particular metric hasn't gotten out of hand yet, they also cite the fact of 2 transitory factors, one being the stimulus payments, and the other factor that when everyone was dealing with this issue and we all stayed home, we didn't spend as much money. And that's why this ratio hasn't already got to the point of even more exuberance. But I imagine now, when these artificial influences fade away, that will also be one of the 3 indicators telling you that these real estate prices are obviously not sustainable. Several things are coming together all at once now, and they all involve decline. There will be a decline in the wealth effect. When your house increases in value or your stock investments increase in value, you feel wealthier, you spend more money, you get more involved in the economy. 70% of the American economy is consumer-based, which is a problem if that consumption declines. There's also going to be a decline in fear of missing out. A lot of people were being prodded to buy a home because the home prices were increasing so quickly. Same with the stock market, same with a lot of other assets. Increasing so quickly that encouraged more people to buy. I don't think that fear of missing out is in play right now, and that's going to be a decline in that aspect of things. There's a decline in investment naivety. Most people are able, They have access to learning what they need to learn. They're more aware, awake, just like you guys. You guys understand so much more about the economy than you probably realize. And you know a lot more than just about everybody else. There's also going to be a decline in delusion. This is an absolutely delusional market, and all aspects of it is freaking me out, to be quite straightforward with you. But what does this all mean? All of these declines come together, and they put us squarely into what I told you was coming before anybody else is talking about it, if you're paying attention, is a recession, a big one. And then what we have to do at that point, and this is why you should subscribe to these videos, is because I'm going to be telling you what to watch to see if this recession is actually going to become a full-blown depression. And if it is, there's things you have to do differently than if it's just a run-of-the-mill recession. I'll tell you all about it as it all plays out. I'm looking at everything and adjusting my premise. You can have the advantage of that if you subscribe to these videos. So please do that. Support my team and I, and we'll just keep on keeping on. More Americans joined the labor force. So the partition. More Americans joined the labor force. That means the partition. More Americans joined the labor force. That means that partition. More Americans joined the labor force, which means that the participation rate of the